Hey team, I hope you're having a great day and welcome back to Econ Recaps. We got a jam-packed episode discussing the Anthropic military fallout, the Netflix Paramount bidding war, and the newest in AI layoffs. But to kick things off, let's just quickly run through how the benchmarks performed on Friday. So the producer price index data came out early Friday morning and was higher than expected. And this led to a large sell-off in small caps since they usually have to rely on debt instead of equity, and this higher inflation means the Fed's probably not going to cut rates anytime soon. So the Russell 2000 was down 1.7%, the Dow Jones Industrial Average was down a little over 1%, the S&P 500 was down just under 0.5%, and the NASDAQ 100 was down 0.32%. This obviously translated also into the sectors where we saw financials full circle and start and end the week down 2%, with most major banks down 4 to 5%. In typical investor fashion, they had to throw their money somewhere, and we saw a lot of rotation into healthcare and energy, who were up 1.8 and 1.6% respectively. But now let's get into the market news. So putting an end to the long-standing soap opera that has been the Netflix Paramount bidding war for Warner Bros. Discovery, earlier on Friday, Warner Bros. Finally chose, formally signing a merger agreement to accept Paramount's newest offer with a price of $31 per share cash, valuing the total transaction at about $110 billion. As you all probably know, Netflix held a prior agreement to acquire Warner Bros. Studios and their streaming assets and will be paid a $2.8 billion breakup fee since Warner Bros. Is now going with Paramount. Once this was announced, Netflix shares climbed 15% as investors viewed the company's withdrawal as a sign of financial discipline. With over 300 million global subscribers and one of the deepest content libraries in the industry, Netflix simply doesn't need the catalog of Warner Bros. To compete, especially considering how much debt, around $33 billion, that company currently holds, and that they've just posted a negative earnings per share. Funny enough, however, Paramount shares also rose about 25% on the news, as their investors bet that absorbing Warner Bros. Studios' IP and streaming assets would be transformative for the much smaller company. The deal is expected to close in Q3 2026, and obviously it's subject to shareholder approval with a shareholder vote anticipated in early spring. Moving on to our newest piece of drama that also includes the administration, let's talk about the drama between the Department of War and Anthropic. On Friday, February 27th, the Trump administration officially ordered all federal agencies and defense contractors to cease business with the AI agent immediately after they refused to remove safety guardrails from their Claude model, effectively prohibiting the use for mass surveillance and fully autonomous weapons. The standoff is centered around Anthropic's $200 million Pentagon contract, in which the AI model would be used on the US military's classified networks operated via partnership with Palantir, a true match made in heaven. See, Defense Secretary Pete Hegseth had demanded Anthropic to allow Claude to be used for all lawful purposes, but CEO Dario Amodei publicly rejected the Pentagon's final offer, stating the new contract included legalese that would allow those safeguards to be disregarded at will. Essentially, Anthropic just wants to ensure that their product, which their big focus is safe AI, they want to make sure their product won't be used for surveillance and autonomous weapons. Pete Hegseth says, well, it'll be used for all lawful purposes, but CEO Dario Amodei just isn't feeling that. The Pentagon Undersecretary Emil Michael took to Twitter to just publicly call Amodei a liar. And he also confirmed that the Department of War was simultaneously accelerating AI deals with Grok, ChatGPT, and Gemini, with Grok as the clear frontrunner. As a reminder, Peter Thiel, the owner of Palantir, played a huge part in JD Vance getting selected as vice president, and Grok, which is owned by Elon Musk, who played a huge part in Trump getting elected president. So it kind of makes sense that both these companies are the one leading this new military push and getting this new military funding. But surprisingly, Hegseth formally designated Anthropic a supply chain risk, which is a classification normally reserved for foreign adversaries, making Anthropic the first US company to receive such a designation. Hegseth's order states that no contractor, supplier, or partner that does business with the United States military may conduct any commercial activity with Anthropic, which will largely diminish the AI giant's customer base, as they do business and their new products that just came out that goes with the Microsoft Office suite, that goes with FactSet, and is supposed to be really helpful in the white collar banking world and tech world. Well, a lot of these places want to do business with the military and therefore have to cut ties with Anthropic and will have to go to one of their competitors. On February 24th, 2026, AMD and Meta announced a definitive multi-year, multi-generational agreement for Meta to purchase some of AMD's newer AI chips. The Wall Street Journal estimates that this could be worth $100 billion over 5 years. The really crazy part, in my opinion, is that AMD issued Meta a performance-based warrant to purchase up to 160 million shares, or roughly 10% of the company, for just a penny a share. Now, this warrant will be vesting progressively with each gigawatt that's actually delivered and is tied to AMD hitting specific stock price thresholds, including a final tranche that is contingent on AMD reaching $600 a share. First shipments are expected to start in Q3 2026, though Meta will simultaneously maintain its parallel supply chain agreement with NVIDIA. So they're kind of building a dual-sourced AI chip supply chain and no longer kind of only reliant on NVIDIA, which we're seeing kind of a lot of big tech companies do as AI becomes the future. All right, moving on and leaving the AI space for now to the equally speculative crypto industry, we see that this week Coinbase launched commission-free stock and ETF trading for all US customers, offering access to more than 8,000 securities 24 hours a day, 5 days a week, kind of similar to what Robinhood does. Now, CEO Brian Armstrong framed the rollout as the cornerstone of Coinbase's Everything Exchange vision and co-launched the exchange with a partnership with Yahoo Finance, allowing users to kind of research on Yahoo Finance, and then they're one click away from being able to trade on Coinbase. Shares of the crypto pioneer surged more than 13% on the announcement, as investors were willing to look past the poor earnings performance for possible future returns on this new market they're entering. Now, Coinbase is in direct competition with Robinhood, which dominated the zero commission retail trading space so far and launched their own limited crypto exchange, but back in 2018. Moving into some of the layoffs we saw this week, Australian logistics software firm WiseTech Global announced it would be eliminating approximately 2,000 jobs, or nearly 30% of its 7,000 person workforce. The firings will take place over a 2-year restructuring built entirely around AI integration into both its customer-facing and internal operations. Their CEO, who took over after their founder was ousted amid misconduct allegations, called the transformation one of the biggest changes in decades, declaring the era of manual coding finished and noting that projects that once required 6 months to complete can now be done in like a day. This has been noted as Australia's largest AI-driven workforce reduction to date. Following soon after, on February 26th, Block Inc., the parent company of Square, Cash App, and Afterpay, one-upped the Australian tech firm and announced it would cut 40% of its global workforce, eliminating more than 4,000 positions and reducing headcount from approximately 10,000 to 6,000 employees. Co-founder and CEO Jack Dorsey attributed the cuts entirely to AI and that a significantly smaller team using AI could accomplish more. Dorsey emphasized the cuts are strategic, not distress-driven, which seems to be true, though it should be noted that Jack Dorsey does have a habit of overstaffing his companies. Regardless, Block shares jumped 24% on the news as investors bet on dramatically improved margins and efficiency gains. For our final story, and I'm sorry it's also AI related, I bet you guys are all getting sick of hearing about AI, but it literally controlled the markets this week. Just one big piece of news after another. We didn't even get to talk about Anthropic releasing that new kind of product suite to integrate with already existing platforms. But anyways, on Friday the 27th, OpenAI announced the largest private funding round in history, recording $110 billion at a $730 billion pre-money valuation, $840 billion now post-money, anchored by Amazon giving $50 billion, NVIDIA giving $30 billion, SoftBank giving $30 billion, and the round still remaining open for additional financial investors. Now, Microsoft did issue a joint statement with OpenAI, clarifying that its own partnership still remains intact, with Azure retaining the role as exclusive cloud provider for OpenAI's APIs and first-party products. And Wall Street did flag kind of what we're all thinking. Wall Street flagged the growing concern about the circular financing dynamics, given the fact that NVIDIA is now simultaneously one of OpenAI's largest investors and largest customers, which, I get it. Like, they do need each other to grow, but if one of the companies starts to go down, now the other company is losing not only its largest investor, but also its largest customer, and on top of that, a company that it's heavily invested in. So now some of its equity in that other company is also going down. So it's pretty risky business. But getting back to it, this does come before OpenAI's widely anticipated IPO later in 2026. With the company now reporting more than 900 million weekly active users on ChatGPT and 50 million paying consumer subscribers. So thank you for watching Econ Recaps, and we'll see you next week. I hope you have a great night. Cheers.